Hi everyone. So earlier we discussed financial indicators, but there has been a lot of criticism around financial indicators and how they are only correct measures of profitability but not the actual business performance. So today we'll be looking at some of the non-financial indicators. And before we move to that, we will be looking at why financial performance indicators are not enough. So, firstly, financial performance measures includes metrics such as profit margins, return on capital employed. However, many companies have recognized that there are inherent weaknesses in focusing only on financial factors. Firstly, they lead to excessive focus on cost reduction. So sometimes short-term cost reductions may be achieved at the expense of long-term performance due to effect on staff morale, quality, and other factors. So, for example, if you plan to invest in a new plant or machinery equipment, you delay that investment decision, that might save you a lot of money in the short run, but it will also come at the expense of increased business capacity, which can lead to higher profits in the future. Secondly, financial performance measures tend to have an internal focus. To compete successfully, an organization needs to consider external factors such as activities of customers and competitors. Financial measures are traditionally backwards looking. Organizations must consider the future given the current dynamic business environment. And as we discussed, the financial measures only look at the current financial year or maybe the next financial year, but they do not have a long term approach or a long term view, which comprises of like 5 to 10 years, where the business will, how or where the business will go in 5 to 10 years. Financial performance indicators ignore drivers of business success. The things which drive business successes are quality, the quality of your products and services, the delivery, how quickly the customers are able to receive the products and services, customer satisfaction, after sales service, and employee satisfaction. All these five factors are equally important to make or break a business. However, financial performance indicators fail to look into these five factors. Moving on, non-financial performance indicators, aka are also known as NFPIs, just FYI. So, why non financial performance indicators are crucial for measuring performance? So, first, let's develop an understanding of what non financial performance indicators are. These are five examples of non financial performance indicators: quality, the percentage of goods returned due to defects. A low number will indicate a better quality. Delivery time taken from ordering to receiving goods in days. Customer satisfaction, number of repeat customer, after sales service, time taken to resolve problems, employee satisfaction, staff turnover. So let's deeply analyze quality, percentage of goods returned due to defects. So if the quality of your products is great, people love it, then they are likely to be repeat purchases. Customer satisfaction will be high. You don't have to provide after sales service, the cost will automatically reduce. You will get repeat customers will be more, means your revenue will be higher. So the factor of quality is indirectly contributing to the company's profitability, but it is a non-financial indicator. So that what it means by non-financial performance indicators, that quality drives the performance of your business, which can eventually lead to a positive financial impact. So these are drivers of performance, and they are as important as financial performance indicators because these are the things that drive your performance. Like it's mentioned here, NFPs drive business forward in the long run. Financial performance indicators may measure success, but they do not ensure success. Many companies use non-financial performance indicators alongside financial performance measures to give a round picture of performance of an organization. And we can't just say, okay, we'll only use non-financial or we'll only use financial. Both of them are really, really important. And due to this, we have a model balance scorecard which looks at both financial and non-financial performance indicators, and this is the reason why most organizations do use this model. So it comprises of four things. Firstly, customer perspectives. How do our customers see us? And this includes four things. I have given example of customer perspective: satisfaction ratio, retention ratio, referrals and complaints. Referrals are how many people are referring your organization to their friends and family. Complaints, how many complaints you're receiving on a daily basis. Satisfaction ratio and retention ratio are, do you have repeat customers? Internal business processes has to do with production efficiency, cost reduction, cycle time. Learning and growth, how many new products you have launched, how many new branches you have opened, if you have trained any employees or not. And lastly, it's the financial perspective, which measures your ROCE, your profitability, cash flow, all of these things. So within each of perspectives, a business should seek to do the following. Firstly, identify a series of goals, critical success factors. What are the vital areas where things must go right in order for the organization to succeed? And they should establish appropriate measures, KPIs, since what gets measured gets done. We'll be looking into this really deeply as well. So, for example, um, you want to achieve a high satisfaction ratio, see, all right? So your critical success factor is customer satisfaction. KPI will be how you measure this critical success factor. So for example, you're measuring your satisfaction by um, percentage of customers who shop again from the business. So that's your KPI. So critical success factors and KPIs are two different things, and you can refer to my video on performance hierarchy to develop a better understanding on critical success factors and KPIs. Um, this is an overview of balance scorecard. Now let's talk about how this topic gets examined in an exam. So in an exam, what happens is you get a scenario of a company who's using a balance scorecard, and they ask you to evaluate if the company has used correct KPIs for all four perspectives: customer, internal, learning, financial. So for example, if they are using percentage of sales made by repeat customers as a customer perspective KPI, then it is incorrect, because customer perspective KPI is completely non-financial and this is a financial perspective. So that's how you will evaluate your answer. And you can watch my video on balance scorecard exam question, where you will see how we have evaluated each of the KPIs for each of the perspectives in the balance scorecard. Okay, moving on. This is another model that falls in the category of NFPIs, building block model. It is designed by Fitzgerald and Moon as a framework for service companies to develop a performance evaluation system linked to performance schemes for managers. So, service oriented businesses and non service oriented businesses are very different because, firstly, services are intangible. You cannot stop a customer from receiving a bad service, right? Similarly, you cannot store a service. These are non-perishable. So similarly, services cannot be measured. Some people might be happy, some people might not be happy. So you cannot measure the aspects of the service from which a customer is happy and from which a customer is not satisfied. So the building block model is specifically for service companies. Let me also just mark this here so that everyone can see. I should have highlighted it, but I'm sorry, I did not highlight. Okay, so the model is divided into three blocks: dimensions, standards, and rewards. The dimension comprises of six factors: competitiveness, that measures your market position, the ability to stand beside competitors by calculating market share and revenue growth rate. Financial performance, measuring performance from perspective of shareholders, share price, EPS, ROCE, GP margin. Quality of service, complaints, customer satisfaction ratio, retention ratio. Flexibility, adaptability to change, business responsiveness to change, such as delivery time. So for this model, what happens is in an exam, you get asked that please assess KPIs for or building block models, block dimensions or block standards or block rewards. They don't ask you for all three of them, but at least one. They'll be like, for dimensions please suggest KPIs. So for competitiveness you'll have to suggest KPIs. For financial performance you'll have to suggest KPIs. So for competitiveness, your KPI could be market share and revenue growth rate. Similarly, for financial performance, your KPIs could be these. Quality of service, your KPIs could be these. So the things that I've mentioned ahead are the KPIs which you can actually suggest in a real exam question. Flexibility, adaptability to change, business responsiveness to change as delivery time during business busy period. Resource utilization, your productivity ratio, input to output ratio, how much input you are adding and how much output you are taking out. Ideal time ratio, how much time your machines are idle, they are not making anything. Innovation, new product numbers or the number of new services launched. So these are the KPIs for each of the factors mentioned in the dimensions. Um, they're also broken down into downstream results and upstream results. Downstream comprises of competitiveness and financial performance, and upstream has the rest of the factors, that is quality of service, flexibility, resource utilization, and innovation. Okay, so from an exam perspective, you should know what comes in every block. So for dimension, you have six things to remember. These are the six things, and you should know the KPIs also. These are general KPIs. The KPIs you will have to select depends on the scenario that is provided in the exam. These are very general KPIs, so these are applicable in most of the exam questions. Okay, so this was the first block. We'll move to the second block, that is standards. The standards are the targets set for the matrix KPIs chosen from dimensions measured. The standard set should have following characteristics: ownership, achievability, fairness. So if you are uh, setting a target, then it should have ownership of somebody. The managers who participate in setting of the standard are more likely to accept and motivated by the standards, and the managers on whom standards are being imposed. So make sure the manager to whom the target is being allotted has ownership of it. It should be achievable and it should be fair. It should not feel that the target shouldn't feel out of manager's control. It shouldn't be within its control. Rewards is the third block. These are the motivators for employees to work towards the standards set. So, what gets measured gets done. This concept is based upon the fact that if an employee is not accountable, then the work will not get done. If the employee is accountable for the task being assigned to that employee, then that will get done because the employee will have somebody to answer to. It comprises of three factors: clarity, motivating, controllability. So reward should be clear what you will achieve and then you will get this reward. It should be no it should be motivating enough for the employer to achieve that target. The reward has to be substantial, it should be of value so that it motivates the employees. Controllability, reward should be based on a controllable factor. So for example, if a reward is based on the fact that, oh, if the company achieves 8% of operating profit margin, then you'll get a reward. It's not an employee's control, right? Indirectly, it can be argued that it's an employee's control, but what about the external factors? Those, because of that, if the profits decline, then those are uncontrollable factors, right? So the rewards have to have controllability. Lastly, this is the third model of NFPI. It is a performance pyramid. A set of performance measures which improves performance at the organizational performance at many different levels with different focuses. So the level one is at the top of the organization and its corporate vision through which the organization describes how it will achieve long-term success and competitive advantage. It focuses on internal effectiveness and external effectiveness. Internal effectiveness, cycle time, base, productivity, financial and corporate vision. External is quality delivery, customer service, market, corporate vision. So again, these are the factors: market, financial measures, and these are the KPIs that you can suggest for measuring this. So market, customer base, market position, market penetration, you can assess this by market growth, market share, number of customers. Similarly, financial measure: ROCE, residual income, EBITDA, EVA, and ROI. This is return on investment. Level 3 is the tactical level, the mid-level management. If you want to get a better understanding of these levels, this is covered in strategic management and control video, which is uploaded at the beginning, so you can refer to that. Level 3 is the tactical level, customer satisfaction. Customers are happy with the entity and products. Flexibility, adaptability to change, productivity, producing goods in an efficient manner. And these are the KPIs through which you can measure these factors. So if you are looking at material per input, it will help you measure productivity. Similarly, quality and delivery also fall in the tactical level. So there are five things: customer satisfaction, flexibility, productivity, delivery, and quality. Then there is operational level. Okay, no, I'm sorry. These three fall under the tactical level, and this for level 4, these are the four factors: quality, delivery, cycle time, waste. Percentage of late deliveries, complaint ratio, these again are the KPIs that can help you measure these factors. And if you look at this, going back, okay, sorry.